Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to the Treasury Update podcast. I'm Craig Jeffery, your host today. Our episode is called Treasury Technology Tipping Point, and I'm joined by Royston Da Costa. Royston, welcome.
Thank you, Craig.
It's good to be recording with you face to face. It's a different feel than me in my studio, you're in your office, and a large body of water separating us.
Some things technology can't fix in that sense, or replace, I should say.
So this is a bit of a provocative title, right? Treasury Technology Tipping Point. What is the tipping point? And as as you talked about that idea, there's this technology changes, and if we look at them as mountains, you get onto a new type of technology, and very few are on that mountain. Eventually, everyone starts to cross over through the valley of inefficiency as you get rid of your old technology to the new one, and then there's the next one after that, and the next one, and so it's always, hey, this is new, it's shiny. It's not as effective as the old stuff, or it's not as complete.
Yes.
And then all of a sudden it reaches this tipping point because it's just too big, too fast. So maybe you could talk to me about what do you mean by the tipping point, and what's making you think about this next tipping point?
Right. Okay. So this is obviously my personal opinion and view about the tipping point, but I like, again, I have to kind of repeat in some ways the way I see the technology that we work with, and in particular how the TMS world seems to be today, very much in some ways a story. If you think about, and certainly in terms of where my role within Ferguson, when it started back in 2010, I want to say, post-economic crisis, there was a kind of review of where we were with Treasury and technology. The new board came on board, CFO said, look, we need these processes to be more automated. We had a number of systems, but they were not joined up. So we did that, and then we put in our first cloud-based solution in 2015. And in fact, if you think of the terms of the time frame, most TMSs were pretty much chugging along, providing functionality. I don't think there was any groundbreaking TMS. In fact, today, I can't think of any one particular TMS that's sort of doing a particular cutting edge technology that no other TMS is doing. But we'll get to that. I just want to make sure I complete that journey part. 2015 cloud-based solution, then we put in probably in total, we've got about 13 cloud-based solutions. Very fortunate for us that it was pre-pandemic, so when it came to the pandemic, plus some other factors that our company had done and put in place, we were relatively unfazed by the remote working because we'd already been set up to do that. A number of companies were caught short because they hadn't gone onto the cloud, and so therefore now I think they recognize the cloud is kind of way forward. To be honest, I don't see the cloud is important, don't get me wrong, but in the future, I'm kind of a fan of the kind of the data cloud, I think it's called, or where you can have multiple solutions on one platform, mainly because of the KYC challenge that we have in terms of data sharing. Let's look at specifically what's happened since the pandemic, because that, without question, in my view, has been an accelerator in many respects for some of the technology, and certainly the TMS providers, and it should have been, rightly so. The other thing that's interesting that has also happened since then is, and rightly so again, is some banks, not all, but some of the largest banks in the world have been investing huge amounts of investment in technology, which is good. And in fact, some of them are beginning to partner with fintechs. So there's an element there where I've seen as well, from a report I saw recently from Treasury in Europe, that suggests that the number of companies are switching from in-house banking to using their banks. Now, it makes sense to a degree where if you've got banks that are investing in the technology and providing the solutions that you might be running in-house, then why on earth would you want to do that and spend that effort and money when you can get the bank to do it for you? So there's elements of that where it makes sense that the banks are beginning to permeate that space, potentially might have been held by TMSs in the past. So there's a bit of kind of land grabbing taking place, but I don't have a problem with that as long as the corporates are benefiting from it. For the TMSs in particular, I think where their challenge comes in is what's different on the tin that they're offering their customers today versus what they offered 5 years ago, 10 years ago. And I'm being a bit harsh, I know, but I still maintain, if you look at the technology that has evolved, look at what the banks are doing. What are the TMSs doing? Now, again, I'm not trying to chastise the TMS instead, because I believe that they have a service to offer. We look at different technologies pretty much every month, and so often they'll come up with a fantastic solution, and it really is cash pooling, payments, cash visibility. But all these solutions are fantastic up to a point, because they're all reliant on the banks. So they can only do so much in terms of giving you the kind of like window shopping, almost saying, oh wow, you can absolutely do this, this and this. But as soon as you get to the part where the bank's involved, you're kind of like, oh well, sorry, but depends who you bank with, depends whether they can offer that, and most invariably they don't offer that solution. I get that that's the challenge they can't do much about to a degree, but I feel that that's got to change as well, because on one hand the banks have less of an excuse and shouldn't continue dwelling on the fact that they've got legacy systems and they can't do this, that and the other, because that's not going to last for long, especially with this generation who don't typically have a bank account anyway. So the concept of actually being tied into a bank is kind of like not really the same as my generation. But I think with the TMSs, where I see the game changers, and I've maintained this before, quite often, and this unfortunately still exists to a certain degree, most TMSs will look to give a solution that they believe, and I feel that quite often when we say to a vendor, and this happens sometimes quite across the board, not just TMSs, what it is, first of all, they don't ask us the question, what is it you need? And secondly, if you do tell them what you need, they interpret that in the way they want to deliver that solution to you. And I think the tipping point I'm referring to, we're getting to a point where corporates are getting fed up, really fed up with the banks and the TMSs to agree, because where the banks are not offering those solutions to those pain points like KYC, and we've got the technology in blockchain to do that, there's fintechs that offer that already, and with the TMSs where every time you say, can I have just this simple report or this simple change, either you get a response that says, oh, you're the only customer that's asked for this. Now, I'm sorry, I'm going to be a bit facetious. There's 7 billion people on this planet, and you're telling me I'm the only person that asked you this functionality on your system. Anyway, there's that. But there's also the fact that there are certain pain points that are synonymous for the majority of corporates. So at the very least, if we're still talking about those pain points today that we talked about 5 years ago, 10 years ago, 15, 20, so on and so forth, there's something wrong there. And that's where the tipping point comes in. So when I say tipping point, what I'm referring to is that I see in 12 months' time, the TMSs that are more willing to embrace, whether it's the technology or whatever functionality they need to embrace, to provide the corporates the solutions they need, that they are crying out for. They're the ones that will have kind of, let's say, the most promising future. The ones that aren't, I feel, are at huge risk of being discarded and ignored, almost put to one side. Because again, you've got this element of, remember, each year goes past, we've got a changing demographic in the workplace. I know at the moment, I think there's someone said somewhere, we've got the widest range of age groups or generations, I should say, in the workplace, which is not a bad thing, because it's everyone's sharing experiences. But let's say the boomer generation, as each year goes past, certainly by the year 2030, in theory, should have exited the workplace, which means that the generations that are in situ, are much more familiar with technology because they've grown up with it, but B, more importantly, will be the decision makers, and in many cases are the decision makers. So that's beginning to, I think, will have an impact on what technology and which systems and, sort of what corporates are going to be doing, certainly in Treasury going forward. And my view is that this generation in particular are much more engaged in whatever is frictionless, whatever is efficient. Everything is kind of, we talk about faster payments, that sort of experience. So anything that sort of comes up and says, yes, we'll leave that with us, we'll come back to you in 12 months' time once we've developed a solution, I think we'll go to vendor B, they've already got the solution in place. That's where I see this tipping point beginning to really take hold.
That's interesting. It's different than I thought what you would say. The people that are in the workforce now that are becoming supervisors and managers are probably digital first. They're not digital natives, but they're digital first, not digital halfway through my career. That expectation and the impatience is there. The impatience might be a negative term. If you're from my generation or mindset, you may say, oh, they're impatient. But is it? I mean, if the capability exists today, why aren't we using it in this type of application? We see it all in our individual lives technologically, and we see it in certain areas in business. Why not throughout all of Treasury? And so impatience would be, we're not going to tolerate slow moving for no good reason. And it's hard to have a good reason. I mean, the biggest reason is we already have technology that does some of it. If you're a company that has it, like we look at moving to the cloud, in 96, 95, 96, banks were installing their desktop applications. It was going over the private networks, not over the internet. And then it quickly moved to the cloud. As quickly as they could, they moved everything to the cloud. They moved to SaaS offerings before technology providers. Technology providers started really around 2000, 2001 is when they started selling, they call them application service providers, SaaS. Yeah. And by 2005 or 6, more systems were sold in that new type of tech than in the underlying systems. Now, the more expensive systems were more involved. Those are still, largely going on an installed basis. Mm-hmm. By the time you got to 2014, or what was the time your company switched over? 2015. So you already had technology in place. It's a very different decision to say, I'm going to rip out something that's working pretty well, versus I'm doing something completely manual. But then the development speed, the cycle time, how things move, there's a different valuation on that. That's a tipping point too, because it's the mindset of, I'm not going to tolerate the poor process if it's really poor. And then there's also a tipping point is I need to move on to new tech because we're slowed down. Some of the development on the new tech is 5 to 8 times faster than on the previous generation of technology. And even if the previous generation of technology has more capabilities, making the decision to move to something that's growing much more rapidly, increasing its value to you far more rapidly, becomes an easier decision the longer that time frame runs.
And I like, the word you used, impatience, is actually very apt, because this to me demonstrates, and it might be a bit harsh, but I think it's a fair example to use, the difference between the generations. So a good example for me would be, and it's probably less likely so, but if you go back a couple of years, supermarkets. Maybe 4 or 5 years ago, I think it's less so now because they've kind of really migrated to the kind of self-service checkout. But when you look at the demographic that typically goes through a person who's checking you out versus the self-checkout, invariably it's someone who's older goes through someone who wants to be served by someone rather than someone who's younger. And there, it's not just about the technology. In my view, it's about being quicker. They just want to go in to get their shopping and get out as quickly as possible. The same applies when you're getting a coffee or tea, most times in terms. And then we can go to a different subject in some ways, because this kind of typifies to me the behavioral patterns. And I think why it's important, although I'm not an expert on this subject, just purely when we looked at some of the impacts of the pandemic, I've found that the younger generation are much more comfortable, let's say, with communicating with their peers online. They are keen to meet face-to-face, but kind of a bit more focused, a bit more specific. And interestingly, there was another survey that came out from, I think it was Sifted, sponsored by the FT, and this might shock you in a way, it did impress me at first. It said, communication is improved by 50% as a result of AI. And in addition, IQ goes up by 20 points as a result of AI. I think at the very high level, you can see why. It's because you're dealing with less mundane, manual-driven tasks if you're using AI. It heightens everything up to a point, and I've said this in terms of Treasury, when you're not having to press a button to get a report out, but you're actually looking at the report, you've got the time to analyze the report, that's where the value starts getting added in. And third point I want to add very quickly on the whole point about tipping points. I believe the next 12 months will be a tipping point. And for treasurers, we've always been not just tasked, but expected to demonstrate where we add value. Whether it's how we manage exposures, liquidity, looking at KPIs. The technology is there now. The technology is there for us, and to enable us to quantify how we're adding that to value. And this is where, again, I come back to the TMSs. What are they doing to help us to quantify those metrics? Because frankly, they've got the data, right? They've got the data. Make it simple, make it easy. And this has always been a challenge for a lot of TMSs, is reporting. So this is where I feel like now with the AI involved, generative AI, we, sole treasurers, can go on to Claude or use Python or whatever to give us the value and the benefit that we've been talking about in the cash flow forecasting piece. It should be possible for them to do it with KPIs. And it's not just KPIs. It was interesting, in one of our banks, a very large US bank, said, in terms of their API library, they've got literally thousands of APIs, and it's true. Not all of them are relevant for us, but the fact is you've got a choice. And API is, again, another area in terms of technology and AI, of how you can look to using it where appropriate to improve some of your sort of processes and make it a bit more efficient, make it more automated. So it really is a bit of a Alibaba's cave, if you like. It's there for the taking, but we are limited by resource, we are limited by time. So quite often we would turn to the banks, we would turn to our banking partners, our vendors, to see where they can fill in those gaps for us. And it's like, well, this is an opportunity, huge opportunity.
Yeah, thank you so much, Royston. Treasury technology tipping point. Yeah, whether we use the term tipping point or point of inflection, there's a point where things change. We might use the term hockey stick, where things grow slow and then move up. And it depends on, there's some contributing factors to that, which is probably the subject of another discussion. But oftentimes in Treasury, it seems as we've done research over a long period of time, right, as consultants and researchers, when things get to between 15 and 20%, then it tends to be a tipping point. But if it's largely driven through distributed technology, if the banks have it and then it's available, well, then it accelerates from there. If it's done individually, that transition tends to take a little more time, because it has to be driven individually by company to make those changes. So there's a few of those factors.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.